Did you know that 80% of people who start investing in their 20s will likely be millionaires by the time they retire? Yet, most of us still ignore one of the most powerful tools for wealth building: the psychology behind money. Money isn't just about numbers and charts, it's about mindset. In fact, the difference between successful investors and those who struggle often comes down to how they think about wealth. Morgan Housel's The Psychology of Money reveals that what we believe about money, and how we manage our emotions around it, is just as important as how we invest. In this video, we'll dive into some surprising facts, powerful strategies, and the hidden truths about money that most people don't talk about. We'll show you why time, patience, and the right mindset are your secret weapons in building real wealth. Want to know how to turn small decisions into massive growth? Or why lucky investors seem to always come out on top? Stay tuned, because what you'll learn here could change the way you think about money forever. Let's get started. Chapter 1. The Hidden Power of Compounding. How small decisions lead to massive wealth. Compounding is a concept that's easy to understand, but hard to truly appreciate until you see it in action. Morgan Housel explains how small, consistent decisions can have a massive impact on wealth over time. It's not about making big, flashy moves, it's about being patient and letting your investments grow steadily. Warren Buffett, one of the most famous value investors, has often said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Most people fail to see how compounding works in their favor because they expect quick results. They want to see returns overnight, but true wealth building happens over years, even decades. Housel points out that the most important factor in wealth building isn't how much money you make, but how long you let it grow. The longer your money stays invested, the more time it has to compound. For example, if you invest $1,000 and earn 10% a year, you'll have $1,100 after 1 year. At first, the gains seem small. But by the 10th year, your $1,000 would grow to $2,593. And by the 30th year, it would turn into $17,449. This is the magic of compounding. It's slow at first, but it snowballs over time. Investors often make the mistake of pulling out their money too soon, thinking they can achieve faster results elsewhere. But they don't realize the true power of long-term investing. As Housel says, the most important thing you can do with your money is let it grow. By staying invested for the long run, value investors avoid making rash decisions that could interrupt this process. It's a simple idea, but it's incredibly powerful. Small, consistent investments, whether through a 401k or other retirement accounts, can add up in a way that's almost impossible to replicate with risky, high-reward strategies. Value investing focuses on this principle, buying companies with solid fundamentals, holding onto them, and letting compounding do its work. Here's another interesting fact. The average annual return of the S&P 500 over the past 30 years has been around 10%. If you had invested just $10,000 back in 1993, it would have grown to over $175,000 by 2023. That's the power of compounding in action. Housel's emphasis on the long game isn't just theoretical, it's backed by data. In fact, research shows that 85% of long-term wealth comes from just 10% of investments. It's not about picking the right stock at the right time. Instead, it's about choosing a few strong companies and holding them through the ups and downs. Chapter 2. Luck versus Skill. Why investors are always searching for the golden goose. One of the central themes in Housel's book is the delicate balance between luck and skill. While many successful investors like to think their success is purely based on skill, Housel argues that luck plays a much bigger role than most realize. He writes, "The ability to take risk is often based on the good luck of having enough time, money, and confidence." This is especially true in investing. Think about it. No matter how skilled you are, the market is unpredictable. Even the best investors like Peter Lynch have had their fair share of lucky breaks. Lynch once said, "The key to making money in stocks is not to get scared out of them. But what happens when you encounter a market downturn or crisis? Luck can determine if your investments survive or fail." Housel compares investing to driving a car. Most of the time, things go smoothly, but accidents can happen at any moment. What sets the great investors apart is how they respond when things go wrong. They don't panic or sell at a loss. they stay calm and stick to their strategy. The truth is, luck has a huge influence on outcomes, and it's something value investors need to accept. Just because an investor achieves huge success in a short amount of time doesn't necessarily mean they have superior skill. They might just have gotten lucky. This is why it's crucial to be humble and avoid thinking you can outsmart the market every time. Housel uses the story of Bill Gates and his early access to a computer in the 1970s as an example of how luck can shape success. Gates had the talent, but his early exposure to a computer was purely luck. Many others at the time didn't have the same opportunity. In value investing, it's easy to get caught up in the idea of finding the next big thing. But the truth is, the market doesn't always reward skill alone. The real skill in value investing lies in understanding how much of success is due to luck and how much is due to skill. By recognizing the role of luck, you can take a more balanced approach to investing. Don't beat yourself up when things don't go as planned. And don't assume that a big win is all about your skill. Instead, focus on developing a strategy that allows you to take advantage of both skill and luck. Chapter 3. The Paradox of Wealth. Why more money doesn't equal more happiness. Housel introduces a fascinating concept in his book, The Paradox of Wealth. The more money people have, the less happy they often become. This goes against what most people think. Many assume that more wealth equals more happiness. But research shows that after a certain point, more money doesn't lead to more contentment. Housel explains that money is a tool for gaining control over your life, but it's not the end-all be-all. Once your basic needs are met, additional wealth doesn't significantly impact your well-being. In fact, a study by Princeton University found that happiness levels plateau at an income of around $75,000 a year. After that, money doesn't have much effect on how happy someone feels. In the world of investing, value investors often chase after wealth, but they should be careful not to fall into the trap of thinking that more money will lead to more fulfillment. It's about freedom, having the freedom to live your life without worrying about money all the time. Housel argues, true wealth is the ability to wake up every morning and do what you want to do, when you want to do it. A unique perspective Housel offers is that many wealthy individuals are actually afraid of losing their wealth, leading them to take excessive risks or work tirelessly to maintain their status. This constant pressure can create anxiety, rather than happiness. The wealthier someone gets, the more they often feel the need to protect what they have, even at the cost of their peace of mind. Value investors, on the other hand, can benefit from focusing on building financial independence without obsessing over accumulating more and more wealth. By investing in solid companies, staying patient, and focusing on long-term gains, they can achieve the freedom to live life on their own terms, without the constant pressure of having to keep up with others. This perspective shift is essential for value investors. The goal should not be to chase after endless wealth, but to build enough security to live a meaningful life. As Housel says, wealth is what you don't see. It's the cars not driven, the jewelry not bought, the vacations not taken, the work not done. By embracing this mindset, investors can avoid the trap of thinking that happiness and wealth are directly correlated. Instead, they can focus on creating a life where money serves as a tool for freedom, not a source of stress. If you're finding these insights valuable, don't forget to hit the subscribe button to stay updated with more lessons on mastering money and investing. Chapter 4. The Emotional Roller Coaster. How to master fear and greed in investing. Investing is an emotional game. It's easy to make decisions when everything is going well, but how do you handle it when the market dips or crashes? Morgan Housel explains that fear and greed are the two emotions that cause investors to make the worst decisions. Fear can make you sell in a panic when the market falls, and greed can make you chase high returns in risky investments. The trick is learning to control both emotions. Housel highlights how investors often overreact to short-term market movements. For example, when stocks drop, investors may feel the urge to sell, thinking the worst is coming. But history shows that the market always bounces back. In fact, the S&P 500 has returned an average of 10% per year over the long term, despite countless downturns. If you can ignore the noise and stick to your strategy, you'll see better results in the long run. Greed is just as dangerous. When markets are booming, it's tempting to throw your money into anything that seems like it will give you quick returns. This is when value investing can really shine. Value investors focus on long-term growth and ignore the temptation to follow trends. They are patient and disciplined, looking for stocks that are undervalued but have solid potential for growth. One interesting fact is that over a 20-year period, investors who remained fully invested in the S&P 500 outperformed those who tried to time the market. A study by J.P. Morgan found that missing just the 10 best days over that 20-year period could reduce returns by over 50%. That's how powerful emotions like fear and greed can be in shaping your financial future. Housel's advice is simple but effective. Stick to your plan and don't let fear or greed cloud your judgment. If you focus on buying solid, undervalued companies and hold them for the long haul, you'll be better equipped to navigate market fluctuations without getting emotionally caught up. Remember, investing is a marathon, not a sprint. If you're enjoying these strategies, make sure to subscribe to get more tips on how to master money and build lasting wealth. Chapter 5. The Long Road to Success. Why time is your greatest ally. Time is the most important factor in wealth building, but it's often the hardest to appreciate. In his book, Morgan Housel argues that the biggest mistake investors make is underestimating the power of time. When you invest with a long-term mindset, you allow your wealth to grow exponentially through the magic of compounding. Take a moment to think about this. If you had invested just $100 a month for 40 years in an index fund that returned 8% annually, you'd have over $200,000 by the end. If you invested the same amount for just 20 years, you'd only have about $60,000. This shows just how important time is in wealth building. The key takeaway here is that the sooner you start investing, the more time your money has to grow. Even small contributions, made consistently over time, can lead to huge gains. This is why value investors love to buy stocks that are undervalued but have strong fundamentals. They understand that by holding onto these stocks for the long term, they can benefit from the growth of the business over time. Housel also talks about how investors often focus too much on the short term. They worry about daily price fluctuations and try to time the market. But those who have the patience to invest over decades are the ones who usually come out ahead. The best way to take advantage of time is to adopt a long-term strategy and stick to it, no matter how the market behaves in the short term. Interestingly, studies have shown that the average holding period for stocks has dropped dramatically over the years. In the 1960s, investors typically held stocks for about 8 years. Today, that number is down to less than 5 years. This shorter holding period is a reflection of our impatience as a society. But for value investors, this impatience is a risk. The longer you hold onto a strong investment, the more likely it is that it will deliver strong returns. The most successful investors understand that time is their greatest ally. It's not about getting rich overnight, it's about giving your investments the time they need to grow. Value investors know that by staying patient and disciplined, they can achieve long-term success. Don't miss out on future videos. Subscribe for more actionable insights on investing and money management. Chapter 6. The Psychology of Risk. How investors perceive danger and opportunity. Risk is something every investor has to face, but it's often misunderstood. Housel argues that how we perceive risk can have a huge impact on our financial decisions. We tend to overestimate the risk of things we don't understand and underestimate the risk of things we're familiar with. This is why value investing, with its focus on long-term, stable companies, is such a powerful strategy. Most people think of risk as losing money, but in reality, risk is just the possibility that things won't turn out as expected. The key to managing risk is understanding it. In value investing, this means investing in companies that are undervalued, but not overly risky. By doing thorough research, you can make better decisions about where to put your money. Housel points out that some of the most successful investors are the ones who take calculated risks. They understand the potential for both loss and gain, and they are willing to stick to their principles even when others are scared. For example, when Warren Buffett made his famous investment in American Express in the 1960s, he did so at a time when the company was going through a scandal. Many investors saw this as too risky, but Buffett saw an opportunity. He knew the company was strong enough to recover, and his bet paid off in the long run. Risk also comes from how we react to the market. When the market drops, many investors panic and sell their investments, which often locks in their losses. But successful value investors know that downturns are opportunities, not threats. They buy more when prices are low, knowing that the market will eventually recover. An interesting statistic from BlackRock's study on risk perception shows that 67% of investors consider stock market volatility to be a major risk, while only 33% see inflation as a bigger threat to their investments. This shows that many investors are too focused on short-term volatility, instead of thinking about long-term economic trends. Housel's advice is to reframe how we think about risk. Instead of avoiding it, embrace it with the right mindset. Understand that risk isn't something to fear, it's an opportunity to buy valuable assets at a discount. If you're able to control your emotions and stick to a well-thought-out investment strategy, you'll be better positioned to manage risk effectively. In value investing, the goal is to minimize unnecessary risks and focus on the opportunities that fit your strategy. By doing so, you can take advantage of market inefficiencies while protecting yourself from avoidable losses. In the end, it's not about avoiding risk completely, it's about understanding it and using it to your advantage. Thanks for watching. Subscribe now to keep learning how to make smart money decisions and take your investing to the next level.